Hello, everyone, and welcome to the weekly roundup. Today, we will cover the FOMC rate cut, inflation numbers, and general market reaction. Hello, Ben.
Hi, Eva.
Good to be back.
You excited to be back here?
Yeah,
Back? Yeah. Missed a couple Fridays. I'm happy to have you back too.
yeah. You did good on your own.
Yeah, it's harder to fill the empty airwaves. You feel like you're talking to yourself. It's a strange situation.
Right. Okay, let's start with the big one, interest rates. FOMC did 50 bips. How is the market receiving this cut? Does this speak to a larger macroeconomic issue, or are they just being proactive?
Yeah, so it's a great question. I think it caught a lot of people off guard. If you saw the daily on, I think I put it up on Thursday, there's something like 230 economists surveyed, and 215 of them called for a 25 basis point cut. So it certainly caught the market off guard with the size of it. It A couple of reasons why they might do it. Obviously, I think they probably look backwards and see, okay, maybe we should have already done this. We should have done this in July. So let's go with two cuts right away, and hopefully that allows us to play catch up because the unemployment data rose a little bit quicker than they expected, and inflation's come in. So I think it was, the market reacted okay. Initially rallied up into the news, then the press conference, we had a bit of a correction. Market stocks sold off. Yesterday, markets rallied pretty materially, and today it's just been super choppy, I think, as things are starting to reposition. But historically, though, when they go 50 basis points, there's been some pretty prominent events when it's happened before. One of the most prominent was also on September 18th, but it was in 2007. So we hope we don't replicate what happened for the 12 months after that event. So I think it's a bit different this time, but certainly a bit of a shock at the size of the cut.
Yeah. What is the trajectory for interest rates going forward? What do we see?
Yep. So we've looked at this in quite detail, both in Canada and the US. And, if we look out, at least National Bank forecasts Canada, right now we're at 4.25% our overnight rate. Market's already priced in the 25 basis point cut in Canada right now. So market's kind of pricing in, we're at 4% technically in Canada. By second quarter of next year, to kind of middle of next year, we think rates probably come down another, uh, you know, 1.5, 1.75% from there. So overnight rate at 2.75 effectively, is what we think. And so that's Canada. And then on the US side, we think they follow suit. Canada went first, obviously, so we have a bit of a buffer here versus the US, and so we think they probably follow suit. And the futures market 12 months from now puts the US overnight rate at around 3.25. So pretty similar, a drop expected in both Canada and the US over the next 12 months.
Okay, okay. Still a bit on the macros. We saw inflation numbers for Canada align with BOC's targets. Is
Mm.
this sustainable, and what is our expectation in the coming months?
Yeah, so I think the world's trying to sort out, are we back to pre-COVID levels where we lived through decades of deflation, or do we get a bit of a inflation impulse because they're cutting rates? And so I would lean towards the likelihood that, maybe we get a bit of a inflation impulse next year, later next year. But I don't think it's an immediate knee-jerk reaction. I don't think we get that, 6, 7, 8, 9% inflation that we saw 18 months ago. But, maybe we hover between 1.5 and 2.5, and we bounce around at that levels. The pace of the cuts certainly can have an impact on that. If we drop from where we are to zero again, then I think there'd be an inflation risk. But I think at the current path, we're probably more range bound from an inflationary perspective than anything. So that's, I guess, how I would think about it at this point.
Okay. Um, let's talk a bit about oil and gas. We've seen some pressure in that space. What is happening there? Um, do we see some support at these levels?
Yeah, so I think the commodities, particularly oil and gas, natural gas, are good leading indicators for the economy. And, we've seen WTI down 25% over the last 12 months, something like that, which is a reasonable signal for, where we are right now, where the economy is slowed, inflation slowed. Now the central bank is seeing that unemployment's rising. And so that those commodities, oil and gas specifically, that you point to, are pretty good leading indicators. So I do think we're likely bottoming in those areas, and also kind of lining up with what the rest of the macro is telling us presently. So yeah, I think we're bottoming there here.
Okay. Anything else catch your eye this week?
Nothing really material. I mean, I think the biggest thing was the rate cut was quite surprising, and so there was a lot of time looking to see what happened there. There wasn't anything else too much. I'd say the only thing, obviously, was Nike announcement of replacing their CEO was a bit
Yeah.
of a surprise today. Market has liked it, and I like the company, and so I think that's interesting. We'll watch to see how that plays out, what the changes are. We've seen a little bit of this where Starbucks obviously brought in a new CEO as well, and market sentiment is pretty material right now in some of these big companies. So that same thing happened with Disney a couple of years ago. So I'll be watching that. So I'd say that'd be the only thing that jumped out at me.
Okay. Any portfolio changes this week?
So starting to look at trimming Enbridge and TransCanada. They've had quite a good run as rates have started to project that they're coming down. And so that could be an opportunity to switch some of the pipelines to maybe the oil and gas companies, to your point. So reviewing those holdings and saying, do we make a switch, lock in some profits, and move to some of the cheaper energy names at this point? So that's one of the things I've been looking at. Canadian banks have had quite a good run here as well. So we did have some positions in National Bank that I'd switched out a couple of weeks ago into an ETF that owns all of the banks, as a switch to make a change and diversify it out. So I think it would be more where some of those tactical changes to be made. And, to your point, the energy companies are probably quite attractive here. So be looking to do that over the next little while.
Yeah, sounds good. Let's go into the charts.
Excellent. All right. Can you see that okay?
Yes.
Okay, perfect. So we are all right. This is the one. So I think I went over my quota this week. Maybe I have a couple more, but lots of information to look at. But unemployment's been, I think, the big reason that the central banks have put their foot on the gas from a perspective of deciding to cut rates with earnest. With the exception of Japan, which is still raising rates. But this has been the big driver. And so certainly in Canada, we see unemployment rate rising through 6%. And so that's the highest level it's been in quite some time. So that has really put the Bank of Canada in a position where they're concerned. And if you look at the demographic of who is losing their jobs as well, it's quite concerning. So that's jumping up. And then in the US, we've seen unemployment move through that. They have their SOM rule, which once you move through this kind of longer term moving average, it puts some greater concern that we're in a recession or heading towards one. So they've, I think, looked at this as a major reason as to why they have gone at the pace that they did. So further to your question around inflation, so this was the key point that you made just around where we are with inflation, where The Bank of Canada, obviously, if we look historically here, raised rates, and so they've raised rates here. Inflation got up to these high levels, and they've kept the monetary policy quite strict, and so now we're well below their headline inflation number, which is 2%. Obviously, this is a 1 to 3% band, but their target is to be around 2%. As you can see, over the last 20 years, we never actually sit on that line for very long, and I think we likely probably head down to the lower bound range briefly, but the Bank of Canada certainly got lots of room to bring rates lower from here. So this is just a little bit of thinking about what happens next. Is the U.S. central bank has started to cut rates, and so the likelihood, at least over the, let's say, medium term, 12 to 36 months, is that the U.S. dollar is going to go lower into that backdrop as they cut rates, quantitative easing, typical things that they do to stimulate the economy, likely means a lower U.S. dollar. And in turn, likely means a stronger emerging market opportunities. And so if we look through this historically, there's been some periods here where, particularly here in early 2000, where we had a similar setup where emerging markets did extremely well, 2001, 2007. And so this would be a similar setup where I'd start to think about weakening US dollar. Maybe an opportunity comes in the emerging countries, as a lot of their debt is denominated in US dollars. So if US dollar is weakening, that is a positive for the emerging countries. The just next one here, just have a look at, this is 30-year fixed rates, obviously quite elevated from the levels of COVID that we went through, and certainly elevated short term. But if you look at where we are and where we've come, 30-year fixed now back down to 609. So in the US, as you know, or at least I've mentioned a number of times, is that when you buy a mortgage in the US, you buy a 30-year fixed mortgage. So that rate's locked in for 30 years, different than Canada, which is much more susceptible to floating rates. But as this comes down, you should start to see the housing market start to pick up a little bit more. And I do think as these rates come down, the economy is slowing, I think we see further deterioration in these yields, which is certainly a positive for the U.S. economy. So in line a little bit with the view that I think the US dollar probably weakens. This I thought was a great chart just around thinking about what and how China has done versus India since the early 90s, where the two countries from a market cap perspective had similar setups. And then what's transpired since then is India has really taken off from a total stock market return since then, that maybe there is an opportunity here. And yes, I think India can continue to lead and do quite well. Maybe there is an opportunity here to diversify and have some exposure to the Chinese economy, as my view is that US dollar weakens. So I thought this is a great chart to just think about the divergence we've had between the two countries from a market return perspective. That's it on the charts.
Oh, great. Great. So what's on the agenda for next week? What are we tracking?
So there's not too much in the way of Canadian data. There's a GDP number out on Thursday. And then on the US side, there's a little bit more. The Fed likes their PC deflators coming out on Thursday. And they also have some GDP data, but the economic data is pretty weak next week. Not too much on the plan there. Earnings, there's a handful of companies, 4 or 5 companies, Aritzia, Costco, but generally pretty quiet. So nothing really material in the market. So I'd be looking at to see how things are digested from this week, as we've had a lot of volatility the last couple of days as the market's kind of repositioning after this 50 basis point cut. So I'd be looking to see how this plays out and seeing if we need to make some changes.
Great. Thank you, Ben.
Thank you.
Please visit and subscribe to our YouTube page, Hart Investment Group, as well as our blog, Daily Heartbeat, for more financial news and analysis. And also, if you want to have a meeting with Ben or if you need anything, please reach out to me and I'll be more than happy to help. Thank you for listening and have a great weekend, everyone.
Perfect. Thanks. Take care.
Bye.